A very good morning, friends. So, first of all, welcome you all to the classes organized by the Board of Studies, ICAI. I'm Kapileshwar Bhala, and we would be starting today with a very interesting and, of course, a very important topic, and that's financial instruments. I think you can't imagine a paper at the CFI level without a question on financial instruments. I always tell people that one of the core pillars in terms of the Indian accounting standard is financial instruments, because some way or the other you see the application of the standard in almost a lot of standards indeed. So very important standard from the examination point of view. Invariably, you do get a question in the exam on financial instruments. So we'll be spending almost 5 classes on this particular topic. And of course, since these are revisionary classes, we're not going to go to every bit and pin and point in terms of this particular standard. But of course, I will be presenting the standard to you in a form that even if you've got some basic knowledge, it will get polished well, and we'll do a lot of practice questions as well. So a revision of the concepts as well as doing questions with you, that would be on the agenda. Anywhere you feel that you want to ask any questions, please feel free to ask any questions on this, because I know this is a technical standard, and even if you've done this, I'm pretty sure there would be certain questions at the back of your mind which you would like to clarify as well. But anyway, let's start with the very basics with the standard view. So as we're going to move on, we are going to add some complications to this particular standard. So let's begin the journey, and let's start with the topic on financial instruments. Now, whenever I start with the topic on financial instruments, the first thing which comes to my mind, so I'm just going to first organize the very first thing which comes to my mind. Financial instruments is organized in terms of 3 standards. Yes, you heard me correct. It is organized in terms of 3 standards. Now you can imagine the intensity of the standard, where the standard setters had to actually, create 3 standards for a particular topic. You can imagine the level of complications that could be. Don't worry, I'm not scaring you at the moment. So when you look at financial instruments, there are a total of 3 standards which are discussing the aspect of financial instruments. One is Ind AS 32. One is Ind AS 109. And one is Ind AS 107. So there are 3 standards: Ind AS 32, Ind AS 109, and Ind AS 107. And each deals with a different aspect of financial instruments. So Ind AS 32 is talking about financial instruments, and it talks about financial instruments presentation. Ind AS 109 also talks of financial instruments, and it talks of recognition and measurement. It talks of recognition and measurement. The core accounting of financial instruments is contained in this particular standard. And then Ind AS 107, again financial instruments, talks about disclosures. So in any case, our focus in terms of the examination point of view is going to be on Ind AS 32 as well as Ind AS 109. Disclosure aspects, of course, is not what I'm going to deal with these 5 classes. So my focus is going to be on Ind AS 32 as well as Ind AS 109. Now, a little word on Ind AS 32 as well as 109. When you look at Ind AS 32, the standard is financial instruments presentation. The question rises, presentation where? The presentation in the balance sheet. When a company issues an instrument, for example, a company issues a debenture, or for example, when a company issues equity share. So the company has to take a decision. Is it to be going to be presented, mind the words, is it going to be presented as equity in the balance sheet? Or is it going to be presented as a liability in the balance sheet? Because when you look at a balance sheet on the liability side, the heading is equity and liability. Equity means it is own funds. Liability means it is loan funds. So when a company raises funds, whether by way of debentures or let's say preference shares or let's say equity shares, it needs to basically present the instrument either as a own funds equity or as a loan funds that is liability. So Index 32 gives you the parameters on the basis of which you decide that is this instrument going to be presented as equity or is it going to be presented as a liability. So Index 32 is focusing completely on the aspect of presentation in the balance sheet of the company. Is it going to be presented as own funds, that is called equity, or is it going to be presented as a loan funds? I think better call it as liability. So Index 32 is not talking in terms of the accounting treatment. I'm not saying that it doesn't talk of accounting treatment at all, but to begin with, Index 32 is only talking about deciding how to present the instrument as equity, own funds, as liability, loan funds. So today we're going to concentrate on Index 32, learn the parameters which helps me to decide how the instrument is presented in the balance sheet of the company. And I think let me also tell you that when it comes to the disclosures are done in the notes to accounts. The disclosures are done in the notes to accounts. And then comes the core standard, that is Index 109, which talks about recognition and measurement. Now, I think one small little word on recognition and the word measurement. Every standard has got a recognition criteria. I would say all those standards, typically which are asset-based standard, have got a concept called recognition and measurement. For example, if you recall, you've done Index 16, which is on property, plant, equipment. So it talks about recognition criteria. When can I recognize a PPE as an asset in the balance sheet? Because unless and until a recognition criteria is met, you cannot reflect it as an asset in the balance sheet. And once you meet the recognition criteria, the next question is the value at which it is reflected in the balance sheet of the company, the measurement. How do you initially measure the financial instrument? How do you measure it subsequently at each balance sheet date? So I would say the core accounting in terms of the recognition criteria and the measurement. Of course, a main focus is going to be on the measurement aspect, that when it comes to accounting of financial instruments, how do you do the accounting? What is the initial measurement of financial instrument? How do you take care of the subsequent measurement of financial instruments, the financial assets, the financial liabilities, etc.? So typically, I've just given you a very basic introduction that financial instrument means a total of 3 standards addressing 3 different aspects of the standard. Index 32 talks about presentation in the balance sheet. Is it to be presented as equity or liability? Index 109 talks about the core accounting. What is the value at which it is initially measured in the books? How does it take care at each balance sheet date? What is called subsequent measurement? And the related disclosures in 107, that is in the notes to accounts. So this is a very basic input in terms of financial instruments. I thought I'll just first give you that input. Now let's concentrate in terms of Index 32. So I'm now going to move on to the concept of Index 32, talking of the presentation. The presentation. But I think before we discuss the presentation aspect, I'm going to spend a little good time in terms of revising the base concepts with you. Because I believe that if the foundations are strong, then I think the building automatically takes a good structure. So I'm going to spend a little good time explaining you the concept of how do you decide whether a given instrument is equity or is it a liability. So for this, I'm going to first take you to the definition of financial instruments. Now, if you read the definition of financial instruments, if you read the definition of financial instruments in Ind AS 32, interestingly, all the definitions related to financial instruments is given in Ind AS 32. All the definitions which relate to financial instruments are clearly given in Ind AS 32. So you need to first read Ind AS 32, then only you can go to Ind AS 109. The standard says that financial instrument is supposed to be a contract. The standard says that financial instrument is supposed to be a contract. And when you look at the word that it is a contract, we always say that contract has got two parties. Every contract is supposed to be a contract between a minimum of two parties. And in terms of financial instrument, when you say it is a contract between two parties, we can say one of the party is called issuer and the other party is called holder. So a financial instrument is a contract, and it's a contract between two parties. One is called issuer and the other is called holder. Now, who is an issuer? A company which issues the instrument. For example, company XYZ issues debenture. It is the issuer. Company XYZ issues, let's say, equity shares. It is the issuer. And the other company or the investor which invests in those instruments is called holder. Like, for example, you say shareholder. For example, you say debenture holder. So a financial instruments will involve two parties, one company which issues the instrument. The company which issues the instrument is to decide the presentation in the balance sheet on the liability side. And the holder, yes, I think somebody's put his hand up. Yes, please go ahead. I think Samnath, you put your hand up. Can you just, yes, please go ahead.
Sorry, it's mistakenly put, sir.
Okay, not a problem. So as far as the issuer is concerned, he is to present the instrument in the balance sheet on the liability side. So he needs to decide, is it equity or is it liability? So Ind AS 32 tells me that we need to take a decision. Is it supposed to be what we call equity instrument, or is it supposed to be what we call financial liability? Is he going to present the instrument in the balance sheet as equity instrument, own funds, or is it going to be financial liability, that is loan funds? But as far as the holder is concerned, the holder is supposed to present the instrument in the balance sheet, you can say on the asset side. And when he needs to present it on the asset side, in this case, he will only call the instrument as a financial asset. He will always call the instrument as a financial asset. So mind this carefully. When he says it's an equity instrument, he says it's a financial asset. When he says it's a financial liability, he still ends up saying it's a financial asset. So which means when a company issues an instrument, I think let me put that question also so that you can answer on the chat box as well. So when he issues an instrument, he takes a call. Is it equity instrument to be presented as equity, that is called equity instrument, or to be presented as a financial liability? But he would land up saying always it's a financial asset. What is equity instrument for the issuer is a financial asset for the holder. What is financial liability for the issuer is still a financial asset for the holder. So let me ask you a very obvious question. So at the end of the day, what do you think? Who is to take a decision with reference to the presentation? Is it the issuer or is it the holder who needs to take a decision? Let me get your answers on the chat box. So we can very clearly see the concept in terms of whether the instrument is to be presented as equity or is it to be presented in terms of a liability. Okay, I think I perhaps did not get any answer so far. Maybe your chat is working or not. I don't know. Okay, anyway, so I think one thing which I'd like to answer then in that case, that the decision is to be taken always by the issuer. The issuer needs to take a decision that is it to be presented as equity liability. So what we're going to do in terms of this particular standard, Index 32, we are going to focus in terms of the issuer perspective. And I think I got the answer holder. That's, sorry, issuer. It's not the holder, it's issuer. That's right. So I am now going to give you parameters to take a decision that whether the instrument is equity or is it financial liability. Now, I know, friends, you might have done your concepts as well. I've just given you very basic background for the last 10-15 minutes. Now I'm going to go to the next phase. But before I go to the next phase, let me tell you that I am going to give you a very simple technique of deciding is the instrument equity or is it a liability based on a step-by-step approach. This might be slightly different from the way you might have learned, unless you've seen the videos of the complete sessions on financial instruments on the ICAI YouTube channel. So in any case, if you've seen that, it's good. If not, then I think let's begin the journey. So I'm now going to start with the parameters which are given in the standard to decide that when the issuer issues an instrument, is it equity or liability, which is going to be based on a very simple 3-step model. So I'm going to give you a 3-step model with the help of which I will take my decision. But I'm going to organize my 3-step model in certain phases because I'm going to introduce and revise the concept in phases. So I'm going to give you this 3-step model not once, but I'll revise it again. So I'll give it to you in 3 parts. I'll give you the 3-step model, change it once. Then I'll give you the new model and then change it again. So I'm going to change the model twice. So let's begin with the very first version. So I am giving you a very simple 3-step model. So let's give you a very simple 3-step model to decide the things from the issuer point of view. And this is the version number 1. Then I'll add some more inputs to this. So please read this very carefully. The next, I would say, almost around 45 minutes or so, or maybe a little more, is going to be very crucial in terms of getting this understanding. Then we'll develop some charts on all. We'll do some questions for practice as also with you. So what I'm going to do, first of all, in terms of step number 1, let me again remind you, what does this 3-step model take care? It takes care of things from the issuer point of view. So I am taking a decision from the point of view of the issuer to decide, is it equity instrument or is it a financial liability, for which I'm using a 3-step model. Now, the first question which you are going to put across is there a contractual obligation? So we're going to first of all ask ourselves a very simple question, that is there a contractual obligation? Let's underline the word contractual obligation. When you look at the financial instrument from the issuer point of view, mind the words carefully. When you look at the financial instrument from the issuer point of view, your first focus is that is there a contractual obligation? Let's consider a very simple example. Let's say my company made a purchase of goods from a supplier. So can I say, do I have a contractual obligation towards the supplier? Yes, I do. The agreement with the supplier may be writing, maybe an oral agreement, but when I purchase the goods from the supplier, I have a contractual obligation to pay. But let's say, for example, when you look at income taxes payable to the government, I have no contract with the government and therefore the obligation is not contractual. The obligation becomes statutory in nature. So what is important is that the nature of the obligation What is important is that the nature of the obligation has to be contractual in nature. So when you say that the obligation is contractual in nature, you are obliged because you've entered into a contract. It's not an obligation which is by law. Let me, I think, wonderfully tell you one thing very clear. When you look at, for example, Index 37, when you look at Index 37, it talks about a legal obligation. A legal obligation includes by law, by contract. Here we are not saying it's by law. When I say contractual obligation, it is contractual. It is not by law. So if there is any obligation which is imposed by law, which is imposed by statutory authorities, it is not contractual in nature. So your very first focus is to see that the obligation is contractual in nature. Now, when you put across this particular question, that is the obligation contractual in nature, then the answer would be either a yes or the answer is either going to be a no. So when you put across a question that is there obligation which is contractual in nature, when you say a yes, you go to step 2. And if you say no, I would say the standard does not apply, because unless the obligation is by contract, the standard cannot apply. So if you say no, the standard is not applicable. And if you say a yes, then in that case, we go to step number 2. So you don't need to hurry up in terms of analyzing things. I remember, previously 1 or 2 attempts back, there was a question in the exam where the examiner was testing in the MCQ your understanding on the parameters of Index 32. Where you need to be very careful in terms of analyzing the very first step, that the obligation is contractual in nature. Sometimes the obligation which is contractual in nature may still fail the step number 2. I'll give you an example of that very shortly. So get the first focus very clear. Your very first focus would be that is the issuer, because everything is being seen from the issuer point of view. You need to see that is the issuer got a contractual obligation. If you say no, the standard does not apply. If you say yes, the standard, you go to step number 2. That's, I think, pretty simple and pretty straight indeed. Now, we go to the step number 2 after looking at the focus on the contractual obligation. We go to the step number 2, which is a very crucial step. Now you need to see that what is the mode of payment. If there is a contractual obligation, that means you're obliged to pay. So your second focus would be that when you are going to make a payment, what is the mode of payment? So my second focus is going to be on the mode of payment. I'm going to focus in terms of the mode of payment. Now, I'm just talking from the examination point of view, don't want to get into too much technical details. So I would say that typically there are 2 modes of payment. Either I'm going to make a payment in terms of cash, or as you know, the standard may allow you to make a payment in terms of your own equity shares. I use my own equity share as a currency note. I tell somebody that I need to pay you, let's say 10 lakh rupee. So I said, okay, I have a share which is quoted in the market at 500. So I said 10 lakhs divided by 500. Let me decide that I will discharge my obligation by giving you equity shares. So in this particular case, you need to focus on the mode of payment. And generally, I said generally, there are only going to be 2 modes of payment with which we will take a decision. So either the mode of payment is supposed to be cash, or the mode of payment is supposed to be a company uses its own equity shares for the purpose of making a settlement of its obligation. So in this particular case, if the mode of payment is cash, as of now, I'll make changes later. As of now, if the mode of payment is supposed to be cash, we are going to classify this as a financial liability. So the mode of payment is supposed to be cash. I'm going to call this as a financial liability. And if the mode of payment is equity shares, we're not going to rush through. We will go to the step number 3. Go step by step. So your focus in terms of step number 2 is looking at the mode of payment. How will you discharge the contractual obligation? If it is by way of cash, I'm going to say that it is a financial liability. And if it is equity shares, let's go to the step number 3. And then finally, we come to the step number 3. Once you've decided the mode of payment is equity shares, we go to the step number 3. And now the question is to see, is the company going to issue a fixed number of shares, a predetermined fixed number of shares? I think let's take an example to understand this. Let's say, for example, a company has taken 10 lakhs from another company. They borrowed 10 lakhs from another company. So my company, for example, has borrowed 10 lakhs from another company. Now, when I borrow this 10 lakh rupees, I am supposed to, let's say, repay this money after 5 years. I'm just looking at the principal element. I tell the person that today my share is quoted in the market at 500 rupees. I said, okay, let me pre-decide the number of shares to be given to you. So there are two possibilities. When the mode of payment is supposed to be equity shares, in this particular case, you need to evaluate, are you going to give him a fixed number of shares which is pre-decided, which is predetermined? Or you will decide the number of shares to be given at a later date. You tell him that, okay, let me see what is the price after a period of 5 years. Depending upon the price of the share after 5 years, I will divide this 10 lakh by the price after 5 years and I will give you the shares accordingly. That's called a variable number of shares. So when you're looking at the mode of payment in terms of equity shares, you need to evaluate the number of equity shares to be issued. The number of equity shares to be issued, is that fixed in number? Is it predetermined in advance? Or we need to consider that the number of shares are to be decided later. It is variable in nature. If you say that it is fixed number predetermined, it is called an equity instrument. And if it is a variable number of shares, it is called a financial liability. I know I may not be getting into the logics at this stage because that's covered detailed in terms of the detailed lecture. So in between, of course, if you want to ask any questions on the logics, I would still illustrate that part to you. But I think I made myself very clear. Let me just chronologically take a recap in terms of my 3-step model. So let me just go back and let's take a quick recap in terms of the 3 focus points to decide from the issuer point of view, is it a liability or is it an equity instrument? Focus 1. In step number 1, your focus is only the obligation is contractual in nature. Contractual means by agreement, not by law. If there is a obligation imposed by way of a statute, by way of a law, it's not covered under this standard. The obligation has to be by contract in nature. If you say no, the standard outrightly would not apply. If you say yes, you go to step 2. In terms of the step number 2, you need to focus on the mode of payment. How are you going to settle the obligation? So for the time being, as I said, I'm giving you a version 1. If the mode of payment is cash, it's a financial liability. But if the mode of payment is equity shares, you plan to give your own equity shares to settle the obligation. I'll go to step 3. So first is contractual obligation. Second is the mode of payment. And third is, if the mode of payment is equity shares, you're going to see, are you going to give a predetermined fixed number of shares? Then it's equity instrument. And are you going to give a variable shares to be decided later? Then it is supposed to be financial liability. Did you get the 3-step model, the first version of 3-step model? I did not give you much logics. I'm just trying to recap the learnings which we have developed over a period of time in the detailed lectures. So far, so good. Am I clear with the 3-step model? Contractual obligation, mode of payment, and then equity shares is mode. How do you decide the picture? Wonderful indeed. So I think my focus points which comes out of this learning is your mode of payment is cash, financial liability. Your mode of payment is fixed shares, equity instrument. Your mode of payment is variable shares. It is a financial liability. Now I think let's go further. Let's go further. This is the very first input. Now I need to make some changes. I'm going to first of all make changes to the step number 2. That's version number 2 I'll give you. Then I'm going to make changes in the step number 3. And then we'll just look at some questions for practice. So I'm going to take you step by step. I'm going to first of all take you to the inputs in terms of the version number 2. I'm going to make changes to the step number 2. No changes in step 1. No changes in step 1. Okay, by the way, let me also give you one simple clarification at this stage. Let's say, for example, my company, I'm going to put some quick questions now to you. Let's say, for example, my company made a sale of a laptop and gave a warranty to the customer. I made a sale of a laptop and gave a warranty to the customer. Do I have a contractual obligation? Yes or no? My company
No,
made
sir.
a sale of a laptop.
No, sir. It's not a contractual obligation because
It
it's a
is
regular
a
business.
contractual obligation, Beta. It is a contractual obligation. I gave a warranty card to the customer. I am under a contract.
Yes, it's a
It is a
contractual.
contractual obligation. So what
Yes.
do? I go to the step number 2. Now let's go further and let's analyze the step number 2. Is the mode of payment going to be equity shares? Is it going to be cash? Or am I going to provide goods and services to the customer?
Services, sir.
Absolutely correct. So I'm going to provide goods and services. So remember, if your mode of payment is not cash, if the mode of payment is not equity shares, but the mode of payment is goods and services, then it is not a financial instrument. It is not a financial instrument. I know what was going in the back of the mind. When I gave you the example of a warranty card being issued, you must have immediately thought warranty is covered under Index 37. But I wanted to give you the inputs that step number 1 is passing. A couple of minutes back, I said your step 1 can get met, but you might fail the step number 2. So let me ask you outrightly another question. Let's say, for example, my customer gives me an advance. I get an advance from the customer. Can I say, is this a financial instrument? When he gives me an advance, I have a contractual obligation towards my customer. But am I going to give him cash, equity shares, or goods and service?
So goods and service.
Goods and service.
Absolutely. So therefore, this is not going to be financial instrument. So any kind of advances received against which you are going to provide goods and services are not financial instrument. So more or less, you can say the mode of payment is a very important feature. That the obligations which is by contract is discharged in which manner, because it can be cash, it can be equity shares. Generally, it is only if the mode of payment is cash or equity shares, it comes under the purview of financial instruments. If there is a mode of payment other than this, like for example we said goods and services, then it is not supposed to be a financial instrument. Okay, now I think let's give you some more inputs. And I said, I'm now going to give you a changes in step number 2. I'm going to give you changes in step number 2. So I am now making a change in step number 2. The step 1 remains the same. I'm just making a changes in step 2. After making the changes in step 2, I'll make changes to step 3. And then I will consolidate all the 3 steps. And then we'll look at some questions for practice as well. So let's, I think, look at first of all the changes in terms of step 2. Earlier in step number 2, what I said if the mode of payment is supposed to be cash, I said if the mode of payment is supposed to be cash, I said it is supposed to be a financial liability. But the answer is now no. Please don't be in a hurry. If you see that the mode of payment is cash, you cannot reach a conclusion that it is supposed to be financial liability. So I am making a change now. If the mode of payment is cash, you will not immediately reach a conclusion that it is a financial liability. Now please hear me very carefully. In terms of step number one, we were using the word called obligation. In terms of the step number one, we were using the word called obligation. Now, let me tell you one thing. Obligation has got two components. Please hear this very carefully. The next 10 minutes are very crucial. So when you're looking in terms of the word obligation, obligation has got two components. For example, if I take 10 lakh rupees, I borrow 10 lakh rupees from someone, I have an obligation to pay interest, component one. I have an obligation to pay the principal, that is component two. So obligation has got two components. Obligation has got two components. And you can say the two components are, number one, you can say the return. When I say the return is in the form of any interest, or return could be in the form of any dividends. So when you say return, we are looking at the return in the form of interest, or return could be in the form of dividends. So a company would be liable to pay some return on the money they've taken. And the second component is the principal element, the principal amount which you have taken. So remember one thing at the background, when we said a company has got a contractual obligation. So I'm focusing that obligation has got two elements. The obligation has got two elements. You can say two components. One is the return, the interest and the dividend to be given during the tenure of the instrument. And the second is the principal, which might be paid, let's say, in one bullet payment. Bullet payment means in one lump sum. Or this amount might be payable, let's say, even in installments. But obligations are two, the principal element and the return element. Now, there is a very simple question which is coming to my mind. This is not what I'm telling you a change. This is a clarification which I'm giving you as of now. Now, my question is very simple. Is it possible that you pay these two components with two different modes of payment? Is it possible that the interest element, wonderful, is it possible that the interest element is paid in cash and the principal is paid in terms of equity shares? Very much. So the question is, should I apply my three-step model to each component separately, or should I apply the three-step to the entire instrument in one go? Analyze and evaluate. If you know that the mode of payment for the interest is in cash, the mode of payment for the principal is in terms of equity share, should I apply my three-step model to every component separately, or should I apply it to the instrument in entirety?
Separately, sir.
Wonderful. So that's what we're going to do. So one clarification which I've given you based on the discussion is that when I am going to apply my three-step model, I am going to apply this three-step model to each component separately. I will apply this to each component on a separate basis. So this is one thing which you need to be very, very careful on. This is not a changes to the step number two. This is just a clarification to the step number two. That when a company is going to apply the three-step model to decide is it equity or liability, you will sit down and say, okay, let me evaluate the three-step model on the interest and dividend element. Let me apply the three-step model to the principal element. And this can lead to some very interesting inputs. So before I give you the changes to step two, let's give you some more interesting inputs which can arise. Let's ask you a very simple question. Let's imagine the interest is paid in cash. So what are you going to call this as? Financial liability, or equity instrument?
Financial liability.
Wonderful indeed, because as of now, what I said, if the mode of payment is cash, it is financial liability. So this becomes a financial liability. And let's say the principal is paid in terms of shares, and we are issuing, let's say, fixed number of shares. So would this be a financial liability or an equity instrument?
Equity instrument.
Wonderful, because it's the mode of payment is fixed, predetermined number of shares, it becomes an equity instrument. One component is a financial liability and another component is an equity instrument. If this happens, it is called a compound financial instrument. Wow. Which means I've given you one more interesting inputs at this particular stage. You are going to apply a three-step model to every component of the instrument. If both the elements are financial liability, the instrument is a financial liability. If both the elements are equity instrument, the instrument is an equity instrument. But if one is financial liability, another is equity instrument, it becomes a CFI. I hope you got the point. I hope you got the very
Yes,
crucial
sir.
point, friends. Great.
Yes, sir.
Yes, sir. Yes, sir.
So I guess I have given you one important clarification. I'm yet to give you the changes to the model. I've just given you what is to be done in terms of three-step model. So when you would apply the three-step model, please remember you need to apply this to every component of the instrument. So when you apply it to the principal component, you reach a conclusion, it's equity or liability. When you apply it to the interest element, return element, you again reach a conclusion. Both elements equity, equity. Both elements FL, FL. One equity, one FL. That's called a compound financial instrument. Don't worry, we're going to make some interesting charts also later. Once I'm done the amendments to all these things, let's go further. So I guess I've given you that in step number 2, if the mode of payment is cash, for the time being, we said it is a financial liability. But I want to now make changes. Let's now introduce the changes in terms of the step number 2. So I'm now coming back to the step number 2 to make my changes, which I said if your mode of payment is cash, don't say it is a financial liability. So what do? There will be certain interesting terminology which will be given with reference to return and which will be given with reference to the principal. So when you are going to evaluate that mode of payment is cash, I'll say, okay, are you talking about the return element or are you talking about the principal element? So we'll apply this simple little chart. We'll say, are you evaluating the return component or are you evaluating the principal component? And accordingly, depending upon the terms, we will evaluate that whether it is a financial liability or it is an equity instrument. Now, let me put a generic sentence first of all to you. Let me put a generic sentence in front of you. You know, if you want to call the component of the instrument as financial liability, mind the words, I'm saying if you want to call a particular component of the instrument as a financial liability, there should be an unavoidable obligation to pay. If you want to call a particular component of the instrument as a financial liability, there should be an unavoidable obligation to pay. Now, how would I make an assessment that there is an unavoidable obligation to pay? In order to assess that there is an unavoidable obligation for return, the question will use the word mandatory, or the question is going to use the word that is called discretionary. So I will accordingly read these words and decide that is it financial liability or equity. So what you need to keep in the back of the mind is, in order to call that the component is a financial liability, there should be unavoidable obligation to pay. There should be unavoidable obligation to pay. Tell me, if it is mandatory, is there an unavoidable obligation to pay?
Yes, sir.
Yes, sir.
Yes,
Yes,
so
sir.
it becomes a financial liability. But if the company says that we've got a discretionary obligation to pay, then do you think there is an unavoidable obligation to pay cash? No. Then
No.
in that particular case, it will become an equity instrument. The component will be called equity instrument, which means now when you're going to look at the return component, you're going to look at these words. You're going to look at these words. You're going to look at the word, is it mandatory interest or dividend? Then it is financial liability. Is it discretionary interest or dividend? Then it is equity instrument. The component becomes equity instrument to that extent. So these words will decide whether the return element is financial liability equity. So remember, if you read the question and it says the payment is in cash, I'll say, okay, let me stop. I'm not going to say that the mode of payment is cash. I'm not going to call it as a financial liability. I'll say, okay, let me first evaluate. Is it mandatory? Is it discretionary? Accordingly, I'll decide. Similarly, as far as the principal component is concerned, the examination questions will give you certain terminology like redeemable, like irredeemable. So they'll use the word which is called redeemable, or they'll use the word which is called irredeemable in nature. Now you tell me, if it is redeemable, do you think there is an
Redeemable means,
unavoidable obligation? Yes.
yes, sir. It's a financial liability.
Wonderful
Redeemable.
indeed. Absolutely correct. And if it is irredeemable, you can decide it is equity instrument. So, what is coming in the back of the mind is something like this. I'm tuning myself. I always tell people that my step-by-step model, sometimes gives a feeling to the people that he is giving us a rule-based accounting. No. I'm just trying to make your life simple. Machine learning. Making you something like a chat GPT, where you can think on a chronological order. We're converting ourselves into AI. AI is getting embedded into our lives. So we also need to think on a step-by-step basis that makes life easy. Because we are able to, the step-by-step concept, what I feel gives you a very clear-cut focus on the wordings in the question. Because you're able to concentrate on the correct words and you're able to look into, identify, and give your answers correctly. So let me shoot some rapid fire questions to you at this stage. So when I say the mode of payment is cash, should I lead to a conclusion that it's a financial liability?
No.
No,
No.
we need to check
Wonderful
whether
indeed.
it is mandatory or non-mandatory.
So can I say the moment the mode of payment is cash, what should come flash into my mind is this chart. So let me now give you some generic terms. Tell me it's financial liability or equity. If it is redeemable,
Redeemable means
Liability.
it's a financial liability.
financial liability. If I say it is mandatory,
Financial liability.
wonderful.
Financial
When I
liability.
say it is discretionary,
Equity instrument.
wonderful. And when I say irredeemable,
Equity
Equity
instrument.
so when you're going to close your eyes and you're going to evaluate that the mode of payment is cash, there should be 4 words flashing to your mind: mandatory, discretionary, redeemable, irredeemable, and accordingly you decide, is it financial liability or equity in nature? I'm just consolidating the learnings, what we have done in terms of the step number 2. After giving you a 3-step model, I gave you a clarification to the 3-step model. And what was the clarification? I said, from now onwards, you need to run your 3-step model in terms of each component of the obligation. There are 2 components of the obligation, return and the principal. Apply this to each and every component separately. Evaluate the 3-step model for the return element, decide FL equity. Apply this for the principal component, decide FL equity. If both components FL, both components equity, one FL, one equity, you call it a CFI. And then I made changes to the step number 2. I said, don't be under the concept that if the mode of payment is cash, I will not say it's a financial liability. I am going to apply this particular chart, and with the help of which I will decide, is it liability or equity? Changes to step number 2 done. Are we clear, friends, with the changes in the step number 2?
Clear, sir.
Super. So now I think let's make changes to the step number 3. I hope if you made your revisions from the, done your study from the ICAI, complete lectures on financial instruments, I'm sure you will be connecting the dots very well. But anybody who is listening to this for the first time, is it?
Yes, sir.
Is it different from what you've done?
No, this is the first time, sir.
Okay, so is it different? Oh, you're learning for the first time. Okay, so but I hope you're able to catch up with this, though this is revisionary, but I hope you're able to catch up. Right?
Right, sir.
Wonderful indeed. Okay, so let's now go further because when we do it in the complete lectures, there are almost like 10 lectures on financial instruments. So being revisionary, it's condensed to 5, but I'm still trying to give you as maximum input we can get in these revisionary lectures as well. Okay, now let's come to the changes which we're going to do to the step number 3. I'm now going to make changes to the step number 3. I'm going to make the changes to step number 3. Step 1 done, closed. Step 2 closed, changes done. Now let's come to the changes in terms of the step number 3. Now this is a very crucial inputs which I'm giving you in terms of step 3. The standard in the definition focuses on the point that if your mode of payment is equity share, because in step number 3, you are looking at the mode of payment as equity shares. You're looking at the mode of payment. You're looking at the mode of payment being equity shares. That is the focus point in terms of step 3. Now, the standard tells me, before I tell you what the standard tells me, let me, give you a little background. Technically speaking, if you ask me, I would say there are 3 kinds of financial instruments. If technically somebody were to tell me that what are the types of financial instruments, I will say there are 3 types of financial instruments. One is called non-derivative. One is called derivative. And one is derivative plus non-derivative combined. So we've got instruments which are non-derivative in nature. There are instruments which are non-derivative in nature, and there are instruments which are derivative in nature, and there are instruments which are derivative and non-derivative combined. So I would say there could be an instrument which is a pure non-derivative instrument, a pure non-derivative instrument. Or there could be an instrument which is a pure derivative instruments. I guess you know that a pure derivative instruments is like entering into forward contract, futures contract, or entering into what we call swaps, options. There are basically 4 kinds of derivative contracts. So one is what is called a futures contract, one is called a forward contract, one is called an option contract, and one is called swaps. Like, for example, we enter into interest rate swaps. So the standard setters decided that when your mode of payment is in terms of equity shares, you need to focus whether the instrument is a non-derivative or is it a derivative. If it is a blend, of course, we'll see later. Let's not get into this. This is an area where it is derivative plus non-derivative. This is what is technically called embedded derivative. This is technically called embedded derivative in nature. It is called embedded derivative. Now you would say, how does an instrument become an embedded derivative? So we can say that it has got both the elements. The most common example which comes across is optionally convertible debenture, for example. If there is a convertible debenture where the holder gets an option to convert, the option to convert is supposed to be a derivative which is included, which is embedded in the instrument. So let's not talk about embedded instruments as of moment. Let's consider that there are derivative or non-derivative instruments. I guess I don't need to revise and tell you that when an instrument is derivative, do you remember that there were how many characteristics in terms of defining the instrument as derivative in nature? Or you want me to give you a quick recap on that?
Yeah, please give a quick recap, sir.
Okay. So I think let's give you the inputs in terms of the derivative contract, a quick inputs on when a contract is a derivative in nature. The word derivative comes from the English word derives. When you look at the word derivative, it comes from the English word derives. So, for example, let's say there is an equity share quoted on the stock market. When there is an equity share which is quoted on the stock market, you can pay and buy the share, take a delivery. You can sell and get the money and give the delivery. So it is a delivery settlement market where you pay, get the shares, and you deliver the share and get the money. You can buy and sell shares on a physical mode on a delivery settlement in a quoted stock exchange. But corresponding to the stock exchange, there is another market which is called a derivative market, where nothing is physically bought and sold, everything is settled in terms of cash. And this derivative market actually derives its value from, you can say, the stock market. So, for a contract to be a derivative in nature, the standard is very clearly said that there are a total of three characteristics. There are a total of three characteristics which need to be met. And when I say three characteristics to be met, which means you need to meet all the three. Any one characteristic is not met, it's not a derivative contract. If you want to call it as a derivative contract, you need to meet all the three characteristics. So you need to meet all the three characteristics in order to call it as a derivative contract in nature. So what are the three characteristics? The characteristic number one is that the derivative derives its value. The derivative derives its value from an underlying asset. From an underlying asset. The derivative derives its value from an underlying asset. As for example, I said, there is an equity share which is quoted on the stock market. Now, in the derivative market, where will this derivative derive its value? It will derive its value from the equity share. So you can say the underlying asset is the equity share. So a derivative instrument is one which is going to derive its value from an underlying asset. It doesn't have its own value. It doesn't have its own value independently. It always derives its value from an underlying asset. The second parameter is that there is either, you can say, zero, or you can say there is negligible. There is either zero or there is negligible investment at time zero. So I'm putting it as TO. TO means at time zero. So there is either no investment, zero investment, or there is a negligible investment. So the day when you enter the contract, you are not paying any money, or you're paying a very nominal amount of money as compared to the contract value. So the investment is either negligible or it is zero. And the third is that there will be a settlement in the future. There will be a settlement in the future. So the contract is going to be settled at a future date. And as I said, all these three conditions have to be met. Any one condition fails and it is not derivative in nature. So when you go to look at a particular instrument or contract entered with a company, you'll have to evaluate all these parameters. That is the instrument supposed to be deriving its value from an underlying asset? Is there a zero or negligible investment? And is the settlement going to be done in the future? And I think, let me outrightly, as I said earlier, give you examples of derivative contracts. Basically, you can say it is either a forward contract, or you can say it is a futures contract, or you can say it is supposed to be options contract, or we can say it is supposed to be a swap. It can be a swap contract. So these are all examples of a pure derivative contract. These are all examples of a pure derivative contract. So is the list exhaustive in terms of pure derivative contracts? More or less, yes. I would say this is more or less an exhaustive list of all the derivative contracts in nature, which meets all the three characteristics. These four items, 100% would meet all four characteristics. If you read a question which talks about a forward, a futures, an options, or a swap arrangement, undoubtedly it is a derivative contract in nature. Great. So I guess I've just given you a quick recap on what is a concept of a derivative. So let's come back on the agenda. So I am now looking at step number 3. The standard now added this element. They said that if your mode of payment is equity shares, you need to evaluate is it a derivative or a non-derivative instrument. And accordingly, you will apply different procedures or parameters to decide financial liability or equity. The inputs which I gave you earlier, I'm going to override that. So in step number 3, when you reach a conclusion that the mode of payment is equity shares, I'll first evaluate, is it a derivative contract? Is it meeting all the 3 elements or not? If not, it's a non-derivative contract. So in step 3, you will first apply these 3 parameters to decide is it derivative, non-derivative, and then proceed further. Let me add on. So I'm now making the changes to my step number 3. If your mode of payment is supposed to be equity shares, if the mode of payment is equity shares, I will now first ask myself a question. I will first ask myself a question that is this a non-derivative contract? Is this supposed to be a non-derivative contract, or is it supposed to be a derivative contract? Is it a derivative or is it a non-derivative contract? How will you decide that? You will evaluate the 3 characteristics which I gave you. If all 3 characteristics are met, it is derivative. If any one fails, it's non-derivative. So derivative would mean that all 3 characteristics are met. Derivative would mean all 3 characteristics are met. And of course, non-derivative would be that any one or more characteristics fails. Any one or more characteristics fail, then it becomes non-derivative in nature. So the moment you come to the step number 3, your focus point is, let me first decide, is it derivative or is it non-derivative? Now, please hear me carefully. This is going to be a little more technical for the next few minutes. When you say that it is non-derivative in nature, the standard says we will conduct a test which is called a fixed test. When you say that it is a derivative contract, the standard says we're going to conduct what is called a fixed test. So the decision in terms of whether it is derivative or is it non-derivative is going to be important because it will decide the kind of test to be conducted. So you need to first of all zero down that is it non-derivative, then you apply a fixed test. If it is derivative, you're going to apply what is called a fixed test. Now the question rises, what is this fixed test? And what is this fixed for a fixed test? And I think I'll give you a basic logic also at this stage. But first, let me give you the concept and then I'll give you the logic as well. Now, when you say that we are applying a fixed test, we are looking at is the number of equity shares fixed or not. When you're applying the fixed test, you are looking at the number of equity share is fixed or not. But when you're applying the fixed for a fixed test, we are looking at not only the number, but also the consideration is fixed or not. So what do you mean by this? No worry, I'll explain. I think let me first ask you a very simple question. Let me first of all ask you a very simple question to understand why a fixed test or why a fixed for a fixed test. Let's say for example, my company, let us say issues, let's not take ESOP, let's take a different one. Let's say a share warrant. I hope you know what is a share warrant. Can I assume safely you know what is a share warrant, right? Shall I presume that to be yes?
Yes, sir.
Nobody wants to. Okay. So I believe you know what a share warrant is. So let's say my company issued a share warrant. Is that a derivative? Is the person getting the share warrant going to pay the money today, or is he going to pay the money in the future? Is going to pay the money in the future? There's going to be a future settlement. So is there any kind of initial investments? No, there is no initial investments. Is the share warrant deriving its price from the equity shares? Yes. So my question to you, is a share warrant a derivative instrument?
Yes,
It
sir.
is
It is a
meeting all
derivative
the three
instrument.
characteristics. Yes.
Yes.
So when you look at a share warrant, the share warrant derives its value from the equity share. Number one, there is no amount which is being paid at time zero. I'll pay money in the future and the settlement will take place at a future date. It's undoubtedly a derivative instrument. Now, my question to you, has the company received any consideration, or are they going to receive the consideration in the future?
In the future.
Great. Is the number of equity shares to be issued against the warrant, can I say, is also going to be determined, either predetermined or it may be determined later, correct? So can I say the number of shares to be given will be given in the future? The consideration to be received by the company will also be in the future. On the contrary, let's say a company issued a fully convertible debenture. Has the company received the consideration? When a company issues a compulsory convertible debenture, has the company already received the consideration?
Yes, sir.
When you've issued debenture, yes, undoubtedly you've already received the consideration. So the consideration is already received. So we're not looking at the consideration, but the shares to be given is to be given in the future. So please mind the input. So in my two example, what I wanted to focus is when you look at a non-derivative instrument like a compulsory convertible debenture, the company has already received the consideration. Consideration is not related to future. The consideration already received. It is only the number of shares to be given is to be given in the future. So what relates to the future is only the number, not the consideration. I hope you're getting the logic. In terms of a non-derivative instrument, what relates to the future is the number of shares to be given. The consideration is already received. But in terms of a derivative contract, the number also relates to the future. The consideration also relates to the future. Therefore, the standard set has said that for a derivative contract, we are going to look at the fixed for a fixed test. So we're going to see the consideration to be received in the future is fixed or not. We're going to see the number of shares to be issued in the future is fixed or not. Mind the words. In a derivative instrument, I'm going to see the consideration to be received in the future is fixed or not. The number to be issued is fixed or not. So the consideration has to be fixed. The number has to be fixed. Any one becomes variable, it's financial liability. If both are fixed, it is equity instrument. In this case, the consideration is already received. So the focus is only on the number. The number is fixed. It is equity. The number is variable. It's financial liability. So they decided to segregate the two kind of tests. And you can see the logic. Why a different test was applied to a derivative and why a different test was applied to a non-derivative. So if it is supposed to be a non-derivative instrument, if it is supposed to be a non-derivative instrument, we will simply look into the fact. If the number is fixed, I'm going to call this as equity instrument. If the number is supposed to be variable, then I'm going to call this as a financial liability. And in terms of a derivative contract, if both are fixed, both means the number as well as the consideration, if both are fixed, it is financial, it is equity instrument. And you can say if any one is variable, any one or both is variable. If any one, either the number is variable or the consideration is variable, it becomes a financial liability. And this was a little complicated part of the three-step model. Let me consolidate the inputs in third step, then let's consolidate the entire inputs as well. So what I am giving you in step number 3 is, if your mode of payment is supposed to be equity shares, you'll stop and start thinking, is it a derivative or is it a non-derivative contract? You'll apply the 3 characteristics which are given to you. If the 3 characteristics are met, it is derivative. Any one or more condition fails, it is non-derivative. Why do we need to decide it is derivative or non-derivative? Because there is a different test to be applied for a derivative or a non-derivative contract. If it is a derivative contract, we will apply a test which is called fixed for a fixed test. We'll see the number of shares to be given is fixed or variable. The consideration to be received against that contract is fixed or variable. When it is a derivative contract which is to be settled in the future, the consideration will be received in the future. The number will be given in the future. So we're looking at both the parameters related to the future, the number also and the consideration also. If both are fixed, it is financial liability. It is equity instrument. Any one or more is variable, then it is financial liability. Both need to be fixed in order to call it as equity. But any one or more characteristics fails, it becomes a non-derivative instrument, in which case we're only going to look at a fixed test, only the number. So moral of the story. When I say the mode of payment is cash, what flashes into your mind? The chart. Redeemable, irredeemable, mandatory, discretionary. The moment I say mode of payment is equity share, what flashes into your mind? Derivative, non-derivative. Accordingly, I decide fixed test, fixed for fixed test. I hope I'm clear with the picture, friends.
Yes, sir.
Wonderful indeed. Time to consolidate all the 3 steps into this. I made the amendments. Let's consolidate and do some practice questions. So you got a choice now. Once I consolidate the 3 steps, you want me to first of all give you some clarification charts and then practice? Or you want to practice first and then give you clarification chart?
First charts and then we'll practice.
That's better. Once we get the charts, then looking at the questions is going to be middle most simple affair. Great. So let's do one thing. First, let's consolidate the picture. Then let's give you some interesting charts on that. And then I think we can do some practice questions with you on that area. So let me now consolidate the inputs in terms of the 3-step model. Let's now concentrate and consolidate. So this is basically, I'm making a quick mind map. I always tell people that what you need to do for the examination point of view, make mind maps. Because it's very important in terms of consolidating your learnings. It's very difficult to go through pages and volumes of registers and all those things at the, just before the exams. So it is a good idea that whenever you've learned some concepts and practice, make some quick, 1 or 2 page summaries on different aspects of the standard. Try to condense the entire financial reporting in around 80 to 100 page, kind of a booklet, which is tailor-made to your needs. When you look at that particular, chart, everything flashes back to the mind. Okay, this. So let's, I think, consolidate. I think it's almost been around 1 hour, 15, 20 minutes so far. So I'm just trying to consolidate the learnings in the last 1 hour, 15, 20 minutes. So we stand at a common platform. So I'm making this mind map. I generally do that, after progressing a bit in terms of the concept, I try to consolidate the learnings. So the first thing which we learn is that when you're going to look at a 3-step model, what do we need to do? We need to apply this. We need to apply this to each component. We need to apply this to each component, underline each component separately. This is the very first focus point which should come to your mind. That when you are going to apply a 3-step model, you're going to apply to each component. So when I say each component, the mind tells me that I'm looking at the return interest dividend, and I'm looking at the principal, run this three-step model for the principal and the return elements separately. Immediately, I'm also going to make a small little inputs at this stage in my box that if the two components are financial liability, the overall instrument is a financial liability. If the two elements are equity instrument, the overall instrument is an equity instrument. But if one element is equity and the other one is a financial liability, it becomes a CFI. This is how you're going to create your mind maps that, okay, this is one agenda. And once you apply this three-step model to each and every component, this is the overall conclusion chart. Then we went ahead with the step number one. In step number one, we decided that the obligation, the focus point is that there is an obligation. And this obligation should be contractual in nature. A simple clarification comes again to the mind. Is this contractual obligation including obligation by law or just contract?
Just a contract, excluding law.
Wonderful indeed. Absolutely. So when I say it is contractual, it is not by law. It is not by law. So we're going to quickly put that in the mind map. It's not by law. And immediately what comes to the mind is income tax. I have no contract with the government to pay them taxes. It is a pure statutory obligation. So I'm just going to put an example in the brackets for my learning that we're looking at income tax. It is by law. It's not covered under the standard. So we're going to focus that yes, when you say the obligation is contractual in nature, so if you say a yes, we are ready to go to the step number two. And if you say a no, the standard is not applicable. So get the focus points very clear under each and every input. Then we go on to the step number two. So let's go to the step number two, consolidating the picture. In terms of the step number two, the focus is on the mode of payment. The focus is on the mode of payment. So in the mode of payment, we immediately come to a simple clarification which we did. We said from the examination point of view, the mode of payment is generally a cash or generally equity shares. So if there is any other mode of payment, typically goods and service, the standard does not apply. So the mode of payment is by way of goods and services. It is not a financial instrument. It is not a financial instrument in this case. And what immediately comes to the mind is another example. If there is an advance received, if there is an advance received from the customer, so we'll put the example. If there is advance received from customer, so when you receive an advance from the customer, you are obliged. There is a contractual obligation, but the obligation will be discharged by way of giving goods and services and not by way of cash, not by way of equity share. So it's not going to be a financial instrument in that case. So the moment you see the mode of payment, what immediately flashes to your mind is a small little chart. So the moment you see the mode of payment is supposed to be, so you say, okay, if the mode of payment is cash, then let me apply this chart. If the mode of payment is equity shares, I'd like to go to step number three. I'd like to go to the step number three in that case. So your mind should be very clear that if the mode of payment is cash, then I am focusing on a chart. Different terminologies for returns, different terminologies for principal. So when you're looking in terms of return and when you're looking in terms of the principal element, in terms of return, we will see two terms. One is mandatory and one is discretionary. And in terms of principal, again, we're going to look at two terms. One is redeemable and one is irredeemable in nature. So when you see that it is mandatory in nature, then in that particular case, we'll call it as a financial liability. And if it is discretionary, it's going to be called as equity instrument. And when it is redeemable, it is a financial liability. And if it is irredeemable, it is again supposed to be equity instrument. So immediately, as the mode of payment comes to your mind should immediately tell you, okay, if it is cash, let me look at the cash. Let me look at the chart. And finally, we come to the step number 3 as well. And that is, if the mode of payment is equity shares, what should flash into your minds at this stage, friends?
Whether it is a derivative or non-derivative.
Superb. So the focus point is going to be, is derivative or non-derivative in nature. So the moment you see, we're going to focus on, is it derivative or is it non-derivative in nature? And this will be decided with the help of 3 characteristics which we evaluated. This is going to be evaluated based on 3 characteristics. So your mind should immediately tell you that, okay, we need to meet all these 3 characteristics in order to call it as a derivative contract. Any one condition fails, it is not supposed to be a derivative contract in nature. So you need to meet all 3 characteristics. So the 3 characteristics which comes to the mind is, it derives its value. Yes. It derives the value from, wonderful indeed, underlying asset.
Zero under negligible investment at the time of initial.
Wonderful indeed. Nil or negligible investment at time 0.
Settlement in future, that consideration.
Wonderful indeed. The future settlement will take place. So settlement would be at a future date. All 3 conditions need to be met. Superb. So as we go to practice the questions, you're going to get more expertise on this area. Okay, so far so good. So let's, I think, go further and extend this derivative, non-derivative elements as well. So then after you've focused on the 3 characteristics and you've decided that it is non-derivative or you've decided it is derivative, you need to come to the conclusion that what kind of test is to be applied. Here it is going to be a fixed test, and for a derivative, it is going to be fixed for a fixed test, correct. So let me also focus on another inputs with you at this stage. When you say it is a fixed test, which fixed are you looking at?
Number of equity shares.
Wonderful, the number of equity shares. And when you're looking at a fixed for a fixed test, then you're looking at number as well as
consideration.
Consideration, superb. So we'll look at the number and we're going to look at the consideration. Both need to be fixed in nature. And then you decide the inputs. If in this case, the number is fixed, it is equity instrument. And if it is variable, then it is financial liability. And in this case, again, if both are fixed, if both elements are fixed, it is equity instrument. And if you say any one or both are variable, any one or both are variable in nature, it becomes a financial liability in that case. So I think now your mind should be working very, very clear that when the mode of payment is cash, focus point, mode of payment is equity share, focus point. Okay, before we make the charts, friends, I want you to do a little self-assessment. You know, we've been spent good time in terms of revising the conceptual base of Indus 32 parameters of deciding the 3 categories. I want you to give yourself a comfort zone, not me a scale. You need to give yourself a comfort zone on a scale of 10. Rate yourself on a scale of 1 to 10 regarding your comfort zone, because that is how I will make my assessment as well in terms of maneuvering my discussions further.
Sir, 10 out of 10, sir.
I love that. That's brilliant indeed. We just got 1 score, I think. What about my other friends at this
So
stage?
9 wants some practice.
That's wonderful indeed. I think 9 is also a pretty good score. I understand practice will, of course, endorse the concepts. That's great.
Comfortable, sir.
Wonderful. Comfortable means what score?
More than average.
More than average means what?
7, 8.
Okay, that's pretty good. Okay, so I think majority has got a score of almost like 9 and 7, 8. That's pretty good indeed. Okay, so I think as we've now consolidated the concept, it's time to make some charts. Because as we said before, we'll do a little practice question, we'll make some charts. So what I am planning to make at least 3 charts with you. And this is a good way to remember things as well. When you revise things in your mind, you know that, okay, I've got a 3-step model. I've got 3 charts for the 3-step model. Then, everything gets mapped up. Because in bigger standards, what I understand is the major issue is consolidating the learnings under the standard, because the standards are huge and there are so many aspects discussed in the standard that is very important to get the chain very clear. What is the movement of the standard? How does the standard actually move? So that your mind map is very clear on that. So that is also one of the reasons of creating step by step. 3 is the number. 3 steps, 3 charts makes life easy. Let's begin. So I'm going to make 3 charts with you. Chart number 1, when I'm going to consider non-derivative instruments, mode of payment cash. I'm going to make a chart number 2, where I'm going to consider non-derivative instruments, mode of payment, equity shares. Then I'm going to consider chart number 3, again non-derivative, mode of payment, cash and equity shares combo. We can make a 4th chart as well, which is on derivative, but I think that's pretty okay. So I'll not make the 4th chart. I'll just look at 3 types of charts, typically dealing with non-derivative. Chart number 1, non-derivative cash payment. Chart number 2, non-derivative, that is mode of payment equity shares. And chart number 3, non-derivative blend of cash and blend of equity shares. And you need to give me answers. If you're able to give answers, trust me, your scores will push up. Your confidence levels will push up. So let's do one thing. Let's make an overall chart now. We're going to make 3 subcharts in this. So I'll give you some permutations and combinations. So I'm keeping the 1st and 2nd chart small, the 3rd one a little bigger in this case. So I am creating some clarification charts. We're creating some clarification charts at this stage. So in the 1st chart, and in all this particular chart, I am considering it's a non-derivative contract. My presumption is it's a non-derivative contract. So in the 1st chart, I'll keep the mode of payment as cash. In the 2nd one, I'm going to keep the mode of payment as equity shares. In the 3rd chart, I'm going to keep the mode of payment as cash and equity shares both. And I think I'm going to consider my return in cash and principal in equity shares. So in this case, I'll take the return in terms of cash and I'm going to take the principal in terms of equity shares. Okay, let's begin the journey, friends, with you. I'm taking the return and I'm taking the principal. So remember, you need to run your 3-step model for the principal and the return separately. I'll give you combo offers and you need to decide, is it FL, is it equity, or is it CFI? Mandatory, redeemable. Decide, friends. Wonderful.
Sir, mandatory
financial liability. Because this is financial liability, this is financial liability, both components financial liability. Next, mandatory, irredeemable.
So Compound financial instrument?
Absolutely correct. It's a compound financial instrument. Very good. I think you would start making questions also now. Discretionary, redeemable.
This is also compound financial instrument.
Super, because this is equity and this is financial liability. It again becomes a compound financial instrument. Would anybody like to clear a fourth combination? I'm sure you can. When you start predicting the combination, your concepts are working very good.
Discretionary redeemable.
Very good. Discretionary, irredeemable. Tell me the combination.
Equity instruments, sir.
Super.
Equity.
It becomes an equity instrument in this case. You know, if you notice something, I'm pretty sure you would have noticed that as well. I've taken this mandatory with a combination redeemable, irredeemable, and I took this as discretionary with a combination redeemable, irredeemable. Trust me, there is no fifth combination. If you can create a fifth combination, you're great. Right? Okay, so I hope the chart number 1 is pretty much clear indeed, that if the mode of payment is cash, what is the results? I think equity shares is simple. Either I'll land up issuing fixed shares or I'll land up issuing variable shares. There is no other combination. So if it is fixed shares, you tell me what it is.
Means a financial instrument.
Well, financial instrument, yes. Equity, liability. Equity.
Equity instrument. Equity
Yes,
instrument.
and variable will be a financial liability. Now, I think the third chart is interesting where you need to apply the concepts carefully because I'm going to give you a mode of payment, cash and shares. So let me ask you quickly one point. Can I say when the mode of payment is cash, the chart comes to the mind? Mandatory, discretionary, correct?
Yes, sir.
And when I look at the principal, equity shares, non-derivative, fixed test, fixed or variable because it's non-derivative, correct?
Yes, sir.
So let's consider the return and the principal permutation combinations. Mandatory and variable. Mandatory, variable shares.
It's financial liability, sir.
Absolutely. Mandatory financial liability, variable financial liability, both components financial liability. Next, mandatory fixed.
Compound financial liability.
Superb. It is compound financial instrument. I'm getting confidence on you. I hope you're also getting confidence on yourself. I'm getting confidence. I hope you're getting confidence on yourself.
Yes, sir.
What do you presume your silence to be? No?
Yes, sir.
Yes,
Very
sir.
good. Then it is discretionary and it is variable.
Compound financial.
Very
Compound
good.
financial
Yes,
instrument.
compound financial instrument again. And I think you can create a fourth combination if your mind is working well.
Discretionary and fixed.
Very good.
Fixed and discretionary.
So discretionary and fixed. And I think you can decide what is the nature.
Equity instruments.
Instrument.
So I think you've been able to answer these questions. Your mind is working very good. This was again mandatory, variable fixed, discretionary, variable fixed. You know, this I think gives us a clarification chart, summarizes the entire inputs in terms of how a non-derivative contracts can be seen. I'm not getting into derivative because derivative you've seen that is fixed for a fixed test. So this gives you the combination in the mode of payment is cash if it is equity shares or if it is cash and equity shares combined. I hope, friends, that gives us a clarifications. Now I think we need to practice, but I think before we practice, I think I must give you a small little break. I'm sure you need one. So you can refresh your mind so that we can practice on this because I think once we practice this, then everything will get endorsed. Once we're done with the practice on this area, then we're going to come to the aspect of compound financial instruments in detail because Index 32 typically you can say focuses on two areas. One is in terms of deciding the instrument is equity, liability, or compound, and it gives you a detailed accounting treatment on a compound financial instrument as well. But I think let's first give you a break. Then we'll do some practice questions with you and then discuss the compound instruments with you. So 10 minutes, 10, 12 minutes at the max. I'll be there after the break, friends. So please enjoy your break and we'll see you after the break. Thank you.
Thank you, sir.
I guess you've relaxed your minds, and now we can do a little practice on the concept we have learned. So I'm just going to share some questions to you on the screen. Just give me a second. And these are questions
Okay, sir.
I have taken from the study material itself. Just give me a second. Okay, I'm going to share a question to you on the screen through my laptop. Just have a look at this. I hope you can see the question.
Sir, visible, sir.
Wonderful. So just let's read the question and let's decide, is it supposed to be equity instrument, financial liability, whatever. So let's decide the combination. It says C issues convertible debenture and for subscription of 100 crores. And those debentures are convertible after 5 years into equity share using a predetermined formula. Mind you, it's not a predetermined number. It's a predetermined formula. You can look at the formula 100 crores in the numerator multiplied with 1 plus 10%. The 10% seems to be the interest compounded raised to power 5. So it's like, principal amount is being paid with the interest compounded for the next 5 years. And then it is divided by the fair value on the rate of conversion. That means fair value 5 years hence. So you need to decide, is it equity, liability, or a CFI?
Sir, in this case, the equity shares is not fixed now. It's a variable.
Correct?
Then it is a financial liability.
Superb. But I'll still like to make a walkthrough on my 3-step model because I think, some of you might have missed that particular chain as well. Let me ask you, did you decide it's a derivative or a non-derivative instrument? Truthfully,
It is a non-derivative
did you decide that?
because it's a debenture. Money is received in already.
Okay. So in any case, I think let me pinpoint something first of all. Can I say my step number 1, when C issues convertible debenture, is there a contractual obligation towards R? Yes. I go to the step number 2, what is the mode of payment? Can I say it is equity shares? Then I go to the step number 3, can I say I need to decide it is derivative or non-derivative? By the way, is it a optionally convertible debenture or do you think it's a mandatorily convertible debenture? The language of the question says the debentures are convertible into equity share. When it says they are convertible, is this indicative of a mandatorily convertible instrument? Yes.
Yes,
Yes, sir.
A mandatorily convertible instrument will be non-derivative in nature. And if it is non-derivative in nature, I need to apply a fixed test. Now, if I look at the formula, the predetermined formula which is given, in the numerator, it is a principal with a 10% interest compounded for 5 years, but we're dividing it with a fair value on the date of conversion. So are you pre-deciding the shares or the number will depend upon the price after 5 years? It will vary according to the price prevailing after 5 years. So the number is not predetermined, the number is not fixed, it is variable, and therefore it becomes a financial liability. I hope everybody got the picture very clear.
Yes, sir.
Superb. Let's give you another question on this. This was a question from the study material. Another question I'm taking is also from the study material itself. Let me again share another question to you on the screen. Have a look at this particular question. This is also taken from the study material of the institute. It says Target took a borrowing for 10 lakh rupees and Z enters into an arrangement with Target for settlement of the loan against issue of certain number of equity shares of Target whose value will equal 10 lakhs. For this purpose, the fair value of the share to determine the number of equity shares to be issued shall be determined based on the market price of the equity share at a future date upon settlement of the contract. Is this a financial liability, equity instrument, or a compound financial instrument?
So it's a financial liability because the number of equity shares is variable.
Wonderful indeed. So I think let me just quickly run the 3 steps to you in terms of step number 1. Let me put across the first question in terms of step number 1. Can I say in terms of step 1, does Target have a contractual obligation towards Z? Yes.
Yes, sir.
Step number 2, what is the mode of payment? Equity shares. I go to the step number 3. By the way, is it derivative or non-derivative instrument? Is this also compulsorily convertible instrument?
Non-derivatives.
Yes, because he's very clearly said that the settlement will be done against allotment of equity share. It's a mandatorily convertible instrument again. It's a non-derivative. So I apply the fixed test. He's very clearly said to determine the number of shares, I will take the fair value per share, which will be prevailing at the end of the contract, which means the number will be decided later. It's variable in nature. It's a financial liability. Super. Let's give you one more question, 2-3 more questions to practice. These kind of questions could be asked in MCQs. Of course, you may not get larger questions, but these kind of questions would be a part of that MCQ kind of questions. Let's have a look at another question, which is again picked up from the study material. Have a look at another question. It says D issues convertible debentures to J for a subscription of 100 crores. And then it says those debentures are convertible after 5 years into 15 crore shares of 10 each. Equity, financial liability, CFI.
Equity.
Sir, first, equity instrument.
Wonderful indeed. Can I say it is very clearly given that there are a fixed number of equity shares. It's a predetermined number, 15 crore equity share. Just to still run the 3-step model to be very clear. Can I say, does D Limited have a contractual obligation towards J? Yes.
Yes, sir.
I go to the step number 2. The mode of payment is equity shares. And this is, they are convertible. It's mandatorily convertible. It's non-derivative in nature. The number is already predetermined, fixed in number. It's an equity instrument. So one thing which I like to pinpoint at this stage. When I was reading the question, in many questions, it said the company took a borrowing, the company issued a debenture. Is the nomenclature that you issue a debenture or you take a loan important? Of course not. The standard is working on the concept of substance over legal form. In a legal form, you may call it as a borrowing, you may call it as a debenture, but what we're looking at the substance of the transaction. It is the mode of payment, which is the crucial factor which will decide its a liability, equity, or a compound financial instrument. Great. Let's do a few more questions before we go to the CFI in detail. Another question picked up from the study material. Have a look at this question. It says Silver issued irredeemable preference share. What is going at the back of the mind when you hear the word irredeemable?
Equity instrument.
Absolutely. The moment I hear the word irredeemable, what flashes in my mind is equity. Then he says the face value is 10 with a premium of 90, and these shares carry a dividend of 8% per annum. However, dividend is payable only when Silver declares a dividend on equity share. By the way, should I run my 3-step model on the return and the principal element separately?
Yes, sir.
Yes, sir.
Undoubtedly. So let's apply the three-step model in terms of the return element first. The dividend is at the rate of 8%, but he says dividend is paid only when Silver declares a dividend on equity share. Now, generally, dividend on equity share is mandatory or discretionary?
Discretionary, hence it's equity
Absolutely.
instrument.
So if I tell the preference shareholder that I give you a dividend, if I give a dividend to the equity shareholder, is it also making the preference dividend discretionary in nature?
Yes, sir.
Yes. So that means if the dividend is discretionary, FL or equity?
Equity instrument and
Wonderful.
redemption also equity instrument. Both
Yes,
will
the
cover equity
principle
instrument.
is wonderful indeed. The principle is irredeemable equity. The dividend is discretionary equity. Equity plus equity. The instrument becomes equity in nature. Very good. Super. So is the life becoming easy with all the three-step model? Say yes.
Yes, sir. Absolutely.
Wonderful indeed. Okay, I think one last question on this area, then I think we can go further. So this question which I'm showing you is also picked up from the study material itself. So let's have a look at this. Then I think we'll take a discussions further on the next area. Have a look at this question. It says A issued compulsorily convertible preference share, CCPS. Can I outrightly call it as a non-derivative instrument? Compulsorily convertible? Can I call this as a non-derivative instrument? Because if it is optionally convertible, then it becomes a derivative within the instrument. So I can definitely call this as a non-derivative. Why I'm defining that? Because if it is non-derivative, I know that if the mode of payment is equity shares, I will consider fixed test. Then he says the debentures, they are convertible into equity shares at the end of 10 years, where the number of equity shares to be issued determined on the basis of fair value at the time of conversion. So equity or financial liability, the number of shares to be given is going to be decided on the basis of value after conversion date, on conversion date.
It's a financial liability, sir.
Absolutely correct. What if the conversion is at fixed at the time of issue?
It's equity instruments.
Correct. If the number is fixed, then it becomes equity instrument in nature. So, of course, all the examples I've taken are based on the concept that it is supposed to be a non-derivative contract. If you want, we can take one last example, which could be on a derivative contract. You want me to do that? Your silence says, no, we don't want to do that. That's okay.
Yes, sir. Yes, sir. Please consider.
If you don't say yes, I assume what I presume is good for me. Okay, so one last question on this area of practice. So let's have a look at this question. This is also picked up from the study material. It says A issues warrants to all the existing shareholders. Is this a derivative instrument?
Sir, share warrant is a derivative instrument.
Yes, we decided that, a couple of minutes ago that a share warrant has got all the characteristic of a derivative contract. So you are going to apply which test if the mode of payment is equity share? Fixed for fixed test?
Yes, sir.
Yes,
Fixed for
yes,
fixed test.
A issued warrant to all existing shareholders, enabling them to purchase additional equity shares with a face value 100 at an issue price 150 per share. Is the number of shares to be issued fixed or variable? I said you give me 150 per share. Is the number fixed?
Yeah, number is fixed, sir.
Number is fixed. Is the consideration fixed? Are you going to get 150? There is no range of price. It is a fixed amount of consideration, 150. It's a fixed number per share. So can I say this is meeting the fixed for a fixed test? Equity instrument?
Yes, sir. Yes, sir. Then equity instrument.
Absolutely. Wonderful indeed. I hope this practice makes you a little more confident in terms of things. Say yes.
Yes, sir.
Wonderful indeed.
Obviously.
Great. Superb. Now, I think let's go on to the next area of discussion with you. Having done the discussions on the parameters, how to decide it is equity, liability, or compound, now I'm going to focus in terms of compound financial instruments. My area of discussion now is on a CFI. But before this, I'm interested in telling you a story because I want you to understand the essence of a compound financial instrument in more detail. We've already seen something that how do you decide it is a CFI, but I want to see something more in terms of understanding the essence clearly because we'll be able to appreciate the accounting treatment of a compound financial instrument only once we understand the concept. So let's give you a story. Let's talk about three individuals. Let's talk about three individuals in my story, Mr. A, Mr. B, and Mr. C. And let's give them different expressions according to the things as well. My drawing is not very great, but I just want to still give you, some inputs where you can see that they've got some kind of smiles on their faces. So I think you can pretty well notice different expressions available on three different people. I hope that's correct, right?
Yes, yes,
Three
yes,
different
yes, sir.
expressions. Great.
First
Now I'm
one
going to give you a
smiling, second one not
storyline.
smiling.
Sorry.
First one
First is
smiling, second
smiling.
one not smiling, and he's sad.
You're right. Okay. Now I'm going to give you a storyline and you have to give me answers based on the storyline. It's just to, endorse the concept very well through the storyline to you. Mr. A went to the company and said, I want to invest 10 lakhs into your company. So Mr. A is the issuer or the holder. He goes to the company and says, I will invest 10 lakhs into your company.
Holder.
He's the holder. He's the holder. Now, Mr. A tells the company that I want you to give me a return at market rate. He says the market rate of interest prevailing is at the rate of 12%. I want you to give me a return at a market rate of 12%. He also says that I want you to give me the principal money back after a period of 5 years. He says every year you need to give me a 12% interest, and at the end of 5 years, you need to give me my principal money back. What kind of instrument will the company issue him? He doesn't want to compromise on anything. He wants return at market terms and he wants the principal money back. So, what kind of instrument do you think the company will issue him? A financial liability, an equity instrument, or a CFI?
It's a compound financial liability.
It's a
It's a
compound
CFI is
financial.
a compound, but the thing is that the principal is redeemable.
Okay, let's put it like this. Let's put it like this. Can I say in a financial liability, the company has got a mandatory obligation to pay the returns and
Yes,
the
sir.
mandatory obligation to pay the principal. So, can I say who takes a risk? Is the risk taken by the issuer in financial liability or is the risk taken by the holder? The issuer says, I'll take the money from you. I'll pay you mandatory interest for the next 5 years. I'll give you the principal money back after 5 years. So who is taking a risk, the issuer or the holder?
Issuer.
Issuer. So can I say in this particular case, with this terms, do you think Mr. A is taking a risk or can I say he is not taking any risk?
Not taking any risk.
Because he says, I'll give you the money and I want a return at market terms. I want the principal money back. I am not willing to take even a single paisa of risk. So the risk is completely, what I'm trying to show you now is looking at the identification of the instrument from a risk perspective. Mind the words carefully. I'm now trying to, give you a position from a risk perspective that you can look at the risk perspective. If the risk is completely on the issuer, he says, I'm obliged to give you mandatory returns. I'm obliged to pay your money back. He's under complete risk to pay the money back. So the risk is not of the holder. When he takes no risk, can I call this as a financial liability?
Yes,
Next.
sir.
Great. Next. Now let's go to Mr. B. Mr. B also goes to the company and says that I am also wanting to invest 10 lakhs into the company. He tells the company that I am not worried on the return. I'm not worried on the return. You can give me a return or not. It's your choice. It's your discretion. He also tells the company that you can pay me the money on liquidation. I'm in no hurry to get my principal money back. You can pay me the money only on liquidation. You're not obliged to pay me during the course of the lifetime of the company. He says you can just make the company grow, and if whenever I want to get the money, I'll go to the stock exchange, I will get the money from the stock exchange. What kind of instrument will the company issue, Mr. B?
Equity
Equity instrument.
So let me now look at from the risk perspective. Is Mr. B taking any risk? Yes or no?
Yes,
Yes,
sir.
sir. He's taking risk.
Can I say he is undoubtedly taking a risk? So can you see the two extremes that when it is a financial liability, mind the words, when it is a financial liability, risk is on the issuer, not on the holder. When it is equity instrument, risk is on the holder, not on the issuer. I hope you got my point. The risk is on whose head decides the nature of the instrument. I am looking at the risk perspective to decide the nature. Let me shoot the two questions. And then I'll shoot another third question. If in an instrument the risk is completely on the holder, what kind of instrument is that?
financial liability.
Equity liability. Equity
Equity.
instrument.
When
Instrument,
the risk
sorry.
is completely on the holder, it's an equity instrument. The company says, I take the money, I'm not obliged. It's your risk. So when the risk is completely on the holder, it is equity. If the risk is completely on the issuer,
And financial
Then it is a
liability.
financial liability.
liability. Would you like to make a guess on the third question that if the risk gets divided between the issuer and the holder, what do you think? What kind of instrument that could be?
Compound financial instrument.
Absolutely. So I hope you got my perception from the risk perspective. That if I am looking at an instrument where the risk is on the issuer, FL, risk is on the holder, equity, and if it gets divided, not equally, but it could be in any proportion, then it becomes a CFI. Let's go back to Mr. C. Let's go back to Mr. C. Mr. C also says, somebody's mic is, making some noise at the back. So let's say Mr. C also goes to the company and says, I want to invest 10 lakhs into the company. Now, Mr. C says, I want a return. The company immediately tells him that we will give you return at 10% as compared to the return to given to Mr. B is 12%. Mr. C says, why? If you're giving a 12% return to Mr. A, why do you give me a 10% return? The company says, sir, we will give you an option to convert. Mr. A has got no option to convert. He will get interest for the next 5 years and then the principal is paid in cash. We give you a choice. You want equity shares at the end? You want cash at the end? You decide. Naturally, Mr. C will decide what is better for him. If the price of the share goes up, he would get interested in getting shares. And there is no free lunch in life. So the company tells him that we're going to give you a 10% return, but we will give you an option to convert. We will give you an option to convert. Is Mr. C sacrificing a 2% return in lieu of this option which he's getting?
Yes.
Is Mr. C compromising the 2% return in lieu of the option he's getting?
Yes, sir.
Yes, sir.
Is the company indirectly trying to pass on a risk to Mr. C that they say instead of giving you 12, we give you 10? So is the risk slightly got diverted towards Mr. C? Yes.
Yes, sir.
So what do you
Yes, sir.
think? In this case, the risk is definitely, I will not say complete. Yes, I would say it's a partial risk. Yes, he's partially got a risk. So can I say we will call this as a compound financial instrument? I'm now going to make a very strong statement. I'm going to make two strong statements. Statement number one, comprising of three parts, which I will document as well, So let me, I think, make these two statements carefully to you. So based on my entire storyline, I'm making two important conclusions at this stage. Conclusion number one. Can I say if I look at the risk perspective, let's ask you the question. If the risk is on the issuer, what do you call the instrument as?
Financial liability.
Superb. It's a financial liability. If the risk is on the holder, what do you call the instrument as?
Equity instrument.
Very good. And if the risk is with the issuer and the holder both?
Compound.
Compound
Financial instrument. So that is one input we decided from a risk perception. Which means you've got a three-step model where the mode of payment is the deciding factor. That's one way of looking at things. And along with this, you can also look at the risk perception. Now, another important conclusion which I would like to draw at this stage. Can I say if there is an optionally convertible instrument? If there is an optionally convertible financial instrument, I like to draw two inputs to you at this stage. I'm saying if there is an optionally convertible financial instrument at this stage, can I say the rate of interest? Can I say the rate of interest on a non-convertible instrument will be greater than the convertible instrument? Agreed. If the company pays Mr. A 12%, it will never pay to Mr. C 12%. If I give an option to convert, I will definitely pay interest on a convertible instrument lesser as compared to non-convertible instrument. Am I right?
Yes, sir.
Yes.
And if this be the case, can I say this means passing on the risk? And this means that I will be able to conclude that if this is true, it is definitely a compound financial instrument. So I would say, at least from an examination point of view, if you see that there is an optionally convertible instrument, what you should decide that it is a compound financial instrument. And you will very clearly see in the question that he will give you a data that the rate of interest on a non-convertible instrument will definitely be more as compared to the interest on a convertible instrument. Let me see things again from another point of view as well. Let me see, a thing from another point of view as well. Let me show you something more. Please evaluate a third perspective. I'm showing you things from different point of view. I gave you a three-step model, which is from the mode of payment. I gave you a risk perspective. That was another angle. I'm now giving you another third angle as well, just to give you clarity of thoughts. Now look at the third angle. If you look at the case of Mr. A, is the company repaying every money it borrowed from Mr. A? You took money from Mr. A, 10 lakhs, you pay him interest at market terms, and you pay the principal money back. Can I say I'm repaying every penny I borrow from Mr. A? Is that correct to say?
Yes,
Yes,
sir.
sir.
Yes, sir.
Correct.
Yes, sir. Correct.
If you look at the case of Mr. B, do you think the company is returning every money back which they borrowed, or they're not refunding back?
They are not returning back the interest portion.
Yes, because they tell him that we'll pay you the money on liquidation if there is anything left. Otherwise, thank you. So can I say another way of looking at things is that in terms of Mr. A, the company is paying everything back. So let me put three sentences again. If you repay every penny back as an issuer, can I call it as a financial liability?
Yes, sir.
Yes, sir.
Can I say if you don't repay every penny back, you don't pay anything back, you're not obliged to pay anything back, it's equity instrument from the issuer point of view?
Yes, sir.
Yes, sir.
And can I say if you are paying partially, instead of 12, you're paying 10, It's in between A and B. It's compound.
Yes, sir.
So my mind is now working on three different aspects. You've seen the evaluation from mode of payment. You've seen the evaluation from a risk perspective. You've seen the evaluation from the point of view of repayments as well. And that would decide that, whether it's a compound or is it a financial liability or a CFI. In fact, practically, when we start looking at the instruments, we don't look at any one particular aspect. We look at all three aspects to take a combined decision. Therefore, I give you all three aspects to look at. Oh my God, again, the number is 3. So what is going in the back of the mind? 3-step model, 3 charts, and then 3 perspectives of looking at the fact. I think let's make a simple chart once again to you. So I just want to make another quick mind map at this stage. Let me get the answers from you. And then we'll come back to accounting for CFI. So I'm making another small little mind map in terms of what we have learned on the 3 different perceptions. So what we have learned is looking at 3 perspectives. Looking at 3 different perspectives. I have given you the identification of a liability equity CFI from 3 perspectives. The first learning was from the point of view of mode of payment. The second is from the point of view of risk. And the third is from the point of view of, returns. Are you going to pay the money back? Returns in the sense, are you going to pay back? So let me ask you quick questions and you can decide the inputs and give me answers. If your mode of payment is cash, mandatory, redeemable, can I call it as financial liability? Can I say
Yes, sir.
unavoidable obligation to pay?
Yes, sir.
Unavoidable obligation to pay. So can I say this also means that there is no risk, right? There is no risk for the holder, correct?
Yes.
The moment you say it's mandatory and redeemable, it means a financial liability. There is no risk for the holder. Can I say there is no risk for the holder? It's a financial
Financial
liability.
liability.
It's creating a parity.
Yes, sir.
Yes.
Can I say you are making 100% payback? Can I say 100% payback makes it financial liability? Can you see the parity? That if it is mandatory, it is redeemable, you're saying to the holder, don't worry, you don't take any risk. I pay every money back. If I pay every money back, it's a financial liability. I take a risk, but the holder does not take a risk. It creates a parity. I hope you got the chain clear. Next, discretionary and irredeemable, we said it is equity instrument. Can I say in this case, is there a risk which is taken by the holder? Yes.
Yes,
Because it
sir.
is discretionary. He is taking a complete risk. He is not getting the money guarantee. So in this case, it becomes an equity instrument. And in this case, can I say there is no return? If there is no return guarantee, it is equity instrument in nature. So this is, looking at 3 different perspectives. So whenever you are in a stuck-up situation, start evaluating from the mode of payments, from the risk point of view, and start evaluating from the return perspective as well. And we can say if it is a mixed kind of a situation, then it becomes a compound financial instrument. Then we can say the return is like a mixed situation. It is a compound financial instrument. It is somewhere which is mixed, neither 0 nor 100. It's a mixed situation. And that will happen when you create combinations like mandatory plus irredeemable, or you create combinations like discretionary plus redeemable. This would mean a compound financial instrument. So this is the way we can look into the classification of the instrument. These 2 things are not given in books. These 2 things comes from a practical aspect point of view. So I've just given you that idea so that you can get a very consolidated, view in terms of evaluating the instruments. Right, friends? So far, so good. I hope I'm clear with the chart.
Yes, sir. Great, sir.
Great, wonderful indeed. Now I want to come to a detailed accounting of a compound financial instrument with you. More or less, I'm going to finish with the concept of Index 32 today itself, because I want to devote more time on Index 109, because Index 109 is the place where you're going to get detailed questions in the exam. And there are a lot of subtopics which are there. So I'm going to spend good time in terms of revising the concept of Index 109. So let's come to the accounting treatment of CFI. How the accounting for a CFI is done. Now, please watch the maths carefully. I'll not get into much logics. Logics I've explained even in the detailed lectures. So I'm just going to give you a crux in terms of the accounting. The standard an input that the accounting which is applicable to compound financial instrument is called a split accounting. So the standard says that the accounting which applies to a compound financial instrument is called a split accounting. If a company raises money through a compound financial instruments, which is called, you can say, the proceeds. So what do I need to do? I will consider the proceeds which we have raised, and this proceeds will be split between the financial liability and the equity component. So the standard says the proceeds of the instrument, which is a financial liability, is supposed to be the present value of future cash outflows. It is the present value of the future cash outflows. So the standard says that the liability element, the financial liability element, is the present value of future outflow. The reason is simple. What is my liability? The money I receive is the liability, or the money which I pay is the liability? Liability is what I'm going to pay. If I issue a debenture for 10 lakh, I receive 10 lakh. That's not my liability. My liability is when I'm going to pay interest on that debenture. My liability is when I'm going to pay the principal on that debenture. And all that is going to be paid in the future. So the cash outflows will be in terms of the interest and in terms of the principal money. So in order to calculate the financial liability of the instrument, we will take the present value of the interest, the present value of the principal, which you are going to pay in the future. The question arises that when you consider a present value, what is the discount rate which needs to be considered? What is the discount rate which needs to be considered in terms of calculating the present value? The standard says the benchmark rate is the rate on a non-convertible instrument. When you're going to calculate the present value of the future outflow, you're going to consider a benchmark rate, the discount rate, which is the benchmark rate. So we're going to consider a benchmark rate, which is supposed to be the rate on non-convertible instrument, the rate which prevails on a non-convertible financial instrument. By the way, in my example, in terms of Mr. C, are you going to discount the present value at 10%, or are you going to discount at 12%, which is given to A on a non-convertible instrument? 12%. So remember, there are two key focus points. When you calculate the financial liability, you need to consider the future outflow, interest and the principal. Now, there are some interesting issues on the interest and principal, which I will not discuss at this stage, because there are agendas of discussion, whether it is, let's say, optionally convertible, partially convertible, mandatorily convertible, what are the parameters? We'll see all that later. But what we need to do, we need to consider the future cash outflow, discount them at a benchmark rate, which is a rate on a non-convertible instrument. And say if the proceed is 20 lakhs, and when you take the present value, let's say it comes to 18 lakhs. So what I will do, I will take the equity as a balancing figure, which is supposed to be 2 lakhs in my example. So in order to calculate the split accounting, you will divide the proceeds into two elements. I will calculate the present value of interest and principal at the benchmark rate, That is the liability element of the instrument, and the balancing figure is the equity component of the instrument. I'm now going to do a question with you because I want to now explain the split accounting, the accounting of the financial liability element up to the date of conversion. And I also want to explain the element of equity as well. How do you deal with the equity component of the CFI? But I hope, friends, I'm clear with the picture. How the conceptual split accounting is done. Correct? Let's, I think, take a question with you now on this particular area on a compound financial instrument. So I've created a question of, a good collection of questions also, which I'm going to share you on the board itself, which will give you a good idea in terms of things. Okay, maybe let me first add a question of my own. I'm just going to give you some facts. So let me just give you some basic facts of a question. We're going to do the accounting of this question in a detail. Let's consider the company on 1st July X1. Let us say issued preference shares for 10 lakh. The company issued preference shares, let's say for a consideration of 10 lakhs. And let's consider the tenure is for a period of 3 years. And let me also give you that this preference share is supposed to be optionally convertible. It is, let us say, optionally convertible into equity shares at the end of 3 years. It is optionally convertible into equity shares at the end of 3 years. If option is not exercised, if the option is not exercised, then cash is paid. The issuer is going to pay cash at the end of 3 years. So it's optionally convertible in nature. Another inputs to be added as far as the coupon rate is concerned. Coupon rate means the rate of interest. The coupon rate is supposed to be 6%. So the coupon rate is 6% on this debenture, and we are given the market rate on non-convertible instrument. The market rate, let's say, on a non-convertible instrument, let's say this is 9%. So this is the simple data. Let me ask you a very simple question to begin with. Can I comfortably call this as a compound financial instrument? Yes or no?
Yes, sir.
So,
Can I say this is the case of Mr. C, who is issued an optionally convertible debenture? And we said in an optionally convertible debenture, the coupon interest rate given by the company will always be less as compared to the interest rate which is on a non-convertible instrument. The company will never pay interest which it pays on a non-convertible instrument, which means the company is not paying every penny back. It is undoubtedly a compound financial instrument. Okay, now let's proceed with the solution. So we're going to do a split accounting. We're going to do a split accounting. Now, a few logics of things which I'm going to do today, you're going to get more insights on that in the next class. And next class is going to be very, 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 very crucial indeed, because in the next class, I will create a lot of base concept in terms of Index 109, which will give you not only the logics, but also a lot of clarity in terms of how to think. Okay, now in terms of split accounting, can you tell me what is the proceeds? The company issued the preference shares at 10 lakhs. So can I say the proceed is 10 lakhs?
10 lakh and interest also we need to pay at 6%.
Correct. So that will be split between financial liability and the equity. So in terms of financial liability, can I say the company has got an unavoidable obligation to pay the interest for the next 3 years at 6% and also to pay the principal of 10 lakhs at the end of 3 years. So let's see what is the financial liability element. So the company is going to pay on 10 lakhs interest at the rate of 6%. Can you tell me
60,000.
what is the PVIFA at the rate of 9% for 3 years cumulative? You'll have to give me the calculations. My calculator is not around.
So 2.531.
2.531. And then the company is also going to pay this 10 lakhs at the end of third year. So let's see what is the PVIF at the rate of 9%. This is third year end.
0.772.
0.772. So this is the interest payable for the next 3 years, and this is the principal repayment at the end of third year. Let's take the sum total of the two outflows.
Sir, it's 1,51,860 on the interest portion.
Okay, you can give me the total.
Total, okay. Sir, it's 9,23,860.
923,860. That's the present value of the interest and the principal all put together. Okay.
Yes, sir.
Then I
Yes,
think
sir.
we can, yes. Then I think we can comfortably take equity as a balancing figure. So out of this 10 lakh, reduce this 923, you get the balancing figure equity.
76,140.
77,140.
76,140.
Okay, 76,140, sorry. So 76,140 balancing figure becomes equity. So let's put the entry in this particular case. So I can say the journal entry which we're going to record at inception, bank gets a debit to the extent of 10 lakh. Financial liability gets a credit to the extent of the present value 923,860. And the equity gets a credit of 76,140. So this is the journal entry which will be done at the initial stage. So this will be the initial recognition. So now the question what comes to the mind is, what will I do with this financial liability subsequently, and what will I do with this equity? First of all, let me ask you, where are you going to take this equity element? Where are you going to put this equity element in your financial statements?
In OCI.
No.
No.
It's going to enter in other equity in the balance sheet. This is going to be presented as a non-current liability in the balance sheet, and this is going to be presented as a part of other equity. And you must be knowing that other equity is elaborated by a document called SOKI. So I think many of you may not be too much aware on a detailed concept of SOKI. Can I comfortably assume that you know other comprehensive income, recycling, no recycling, or you want me to explain that in the coming lectures?
So want to you to explain us.
Okay. So today, let me just add one element of inputs to you. So let me just add one simple little input at this stage. Please watch this carefully. This is the balance sheet of the company. This is the extract balance sheet of the company. And in this extract balance sheet of the company, I'm focusing on the equity and liability side. And under the equity side of the balance sheet, you present equity share capital and you present what is called other equity. This other equity is elaborated by a document which is called Statement of Changes in Equity. So when you present this other equity in the balance sheet of the company, this is elaborated by a document which is called Statement of Changes in Equity. And in short, it is called SOKI. So if anybody wants to look at the detailed inputs in terms of other equity appearing in the balance sheet, you need to go to SOKI, a statement of changes in equity. Now, the statement of changes in equity, you might be at least slightly aware, it is divided into a lot of subcolumns. But I segregate this SOKI in terms of a practical point of view, in terms of 3 tabs. You're not going to see that language in books, but this is what we practically use in practical world as well, that the SOKI is divided basically into 3 tabs. There is a tab number 1, there is a tab number 2, and there is a tab number 3. All the columns in SOKI can be segregated into broadly 3 tabs. The tab number 1 is called the equity component of CFI. The tab number 1 is called the equity component of compound financial instrument. So in the journal entry which we did at the inception, the equity component, which was something around 76,000 something, so that figure is going to appear in tab number 1. The tab number 1 contains only one column, that is called equity component of CFI. So it is a part of the other equity in the balance sheet. The tab number 2 is got various subcolumns. It has got a subcolumn like share premium, retained earnings, capital reserve. So this is the tab number 2 collectively. The tab number 2 collectively is called reserve and surplus. The tab number 2 is collectively called reserve and surplus. So it has got various subcolumns. It has got subcolumns like share premium, retained earnings, capital reserve. It has got various subcolumns. Collectively, the tab number 2 is called a reserve and surplus. And then there is a tab number 3, which is nothing but it is other comprehensive income. Whatever is taken in the other comprehensive income in the income statement is all entered in this tab. And there are various subcolumns in this tab. There are various subcolumns in this tab, which you will see as we progress in terms of Ind AS 109. Some columns you're already aware of, like for example, when you consider a PPE at a revaluation model, you get a revaluation surplus, which is a part of the tab number 3. So anything which enters in the other comprehensive income is a part of the larger tab number 3, which is called OCI. There will be a lot of subcolumns in that particular tab. So tab number 1 has got only one column, equity component of CFI. Tab number 2 is called a reserve and surplus, a couple of subcolumns, mainly 3. Share premium, capital reserve, and retained earnings. And the tab number 3 is OCI, other comprehensive income, which has got many subcolumns. I hope you got the picture clear, friends.
Yes, sir.
So this was just to give you a flair that when a company makes a balance sheet, it represents in the equity section of the balance sheet, equity share capital and other equity. Other equity is elaborated by a document which is called Statement of Changes in Equity, SOKI. SOKI has got a total of 3 tabs. So let me come back. So in this particular case, if I come back and say, where will I show this financial liability? This will be reflected in the non-current liabilities under the heading financial liabilities in the balance sheet. So when the company is going to present this particular component, it will be presented under non-current liability, and that also as financial liabilities in the balance sheet. And where will you represent this equity element? It will enter in the balance sheet as a part of other equity, which is presented in SOKI under tab number 1. I now want to give you a detailed treatment of this financial liability for 3 years and a detailed treatment of this equity component for 3 years. So we're just going to work upon two aspects. How does the accounting for financial liability take place for the next 3 years, and how would the accounting for this equity component take place? So let's take the journey forward. So I'm now going to first make a ledger account for a financial liability. We're going to first of all make a ledger account for a financial liability. Then we're also going to look at the other equity, there is equity component as well. Now please hear me very carefully. There is a particular fundamental principle in entire Ind AS. Mind the words, I'm saying there is a fundamental principle in entire Ind AS. You know, in Ind AS, if you consider a present value of inflow or outflow, in the future, I will do what is called unwinding. So when you consider discounting, you do unwinding. So in this case, when you took the financial liability, what did you do? You took the present value of all the future outflow. Now what I'm going to do, I'm going to compound it back. So first you discounted. Now I'm going to unwind the discount. That is called compounding. So let's post the entry. The entry which was done was bank account debit. What was the financial liability element? 923,860. So 923,860 is taken out here. So when you unwind the discount, I'm going to consider the finance charge. So what is the rate at which the discounting was done? 9%. So what is the rate at which compounding will be done? 9%. So calculate a 9% on this.
83,147.
83,147. And this is the interest which will be reflected in the profit and loss of the company. When the company is going to record the interest charge in the income statement, they're going to record this amount, which is based on unwinding. At the end of the first year, the company paid a coupon rate. So on 10 lakhs, which is the face value, you paid a 6% coupon rate, and that is 60,000. And we get a balance CD as a balancing figure. So let's take the balance CD as a balancing figure. So this is the ledger for the first year, the amount of liability, unwinding done, and then the payment is done. So let's see what is the balancing figure.
9,47,000. 007. 9,47,000. Yeah.
Okay, 947,007 is the balancing figure. This becomes the opening balance next year. That is 947,007. Again, I'll do the unwinding of discount. Finance charge will be taken at the rate of 9% on this balance.
85231.
85231.
Then I can again pay the interest at the coupon rate, which is 60,000. And again, I'll take the balance CD as a balancing figure.
It's 9,27,238.
927,238. This becomes the balance BD for the next year. That is 927,238. Now, last year, I will not take the interest. I'll just keep it, as a balancing figure to get my calculations correct. In the last year, there is no need to calculate interest. So what I'm going to do, I'll just leave the finance charge as a balancing figure. Now, what are you going to pay? Now, there is two interesting inputs to be seen. Since it's an optionally convertible instrument, can I say at the end of the year, the holder will say, I want shares. Or the holder will say, I want cash. It is his choice that he can take shares or he can take cash. Now, let's assume that he says, I want cash. And then let's assume if he says, I want shares. So let's look at the two possibilities. If he says, I want to consider cash, he opts for cash. Can I say, I will pay him that 60,000 interest as well as that 10 lakh rupee principal in cash?
Yes, sir.
Let's see what is the finance charge as a balancing figure.
Sir, carried down amount is 9,72,238.
This is not correct. Oh, yes, I think so.
Yeah, that is correct. The brought forward only need to change.
No, this is 947. This 927 is correct.
That is correct, sir. That the brought forward for third year, we have to put this 927 to 238.
Okay, so this is correct.
Yes, sir.
Okay, somebody said this is not correct. It's 947 or something.
Sir, it is 927 written. It is not 927, it is 972.
972, yes, sir. It's wrong figure.
Yes, you're right. It's not 927. You're right. It's coming to more than that. Correct. You're right. So this is 972 to 38.
238.
Okay. Now let's take the interest as a balancing figure.
Eight seven five zero one.
87501. Just to make a cross check, see, is this approximately 9% on the balance BD? Because if the figures are correct, it should be approximately around 9%. Is it coming to approximately 9%? Not exactly, but approximately 9.
No, sir, 87,762 is coming.
Okay, that's
Yes,
okay.
sir.
Approximately just a difference of around 200 or something, because of calculation. That's fine. That's fine.
Sir,
Now, this
in
is the
this
case when he says, I want cash. Let's now consider if he says, I want shares. Because the option is there with the holder. So he may say, I want cash. He may say, no, I want shares. So accordingly, if he says, I want shares, so what will I do? I'll pay that 60,000 interest, of course, in cash. Can I say the 10 lakh rupees will be split between the face value, which will go to the share capital, and the excess will be taken in share premium.
The
The
screen
only
is not
difference is
visible.
that I will split the 10 lakh rupees between the face value and the premium. The credit side still remains the same. So this is how the accounting of the financial liability will take place for the next 3 years to come. Now there is another element also, which is the equity component of CFI. So let's also have a look at what happens to that equity component. So as we've already seen that the equity component will have been entered in SOKI. So this is my statement of changes in equity. This is tab 1, this is tab 2, and tab 3. So can I say when we did the split accounting, we calculated what was the equity element, that is 76,140. So this 76,140 will be entered in the tab number 1. So this is the equity component of the compound financial instrument. Now the question rises, what will the company do with this? Nothing will be done at the end of first year, second year, nothing will be done. This amount will remain in the tab number 1 for the first year, second year. But at the end of third year, when the holder says, I want cash or shares, what will the company do at that particular stage? Watch this carefully. If the holder says, I want cash, I will transfer this to tab number 2 as capital reserve. If the holder says that I want cash, I will transfer this money to the reserve and surplus. So the money in tab 1 will be transferred to the tab 2. Would this change the other equity, or would the other equity still remain the same? If you're going to shift the money from tab number 1 to tab number 2, will it change the other equity, or will the other equity still remain the same?
Remain
other
same.
equity,
It will
other
remain the
equity,
same. It will
yeah.
remain the same because you see, you're shifting one amount from one column to another column. But the sum total of the other equity will still remain the same. It's only shifting from one component of equity to another component of equity. And if the holder says that I want shares, then in this particular case, I will shift it to tab number 2, and this will be under share premium. Because in that case, I will presume that this money which is paid is the excess paid towards allotment of shares. So depending upon that, at the end of 3 years, the holder says, I want cash. If he says, I want cash, I'm going to put it to tab 2, capital reserve. If he says, I want shares, I'm going to put it to tab number 2, share premium. So this will not involve any entry. It is only moving one component of equity to another component of equity. That's it. Right, friends. So I think that takes care of the financial liability accounting as well as the equity component accounting as well. So this was one basic element of question, how the accounting for compound financial instrument is done. I hope you got the picture clear, friends.
Yes, sir.
Great. I'll just consolidate the picture on the split accounting quickly to you, and that would wind up our inputs for the day. So basically, I've given you the accounting for a CFI, which is called a split accounting. In terms of split accounting, the proceeds are to be divided in terms of two elements, financial liability and the equity. The financial liability is the future outflows discounted at a benchmark rate of interest. What is the benchmark rate of interest?
Market rate.
The rate on a non-convertible instrument. So we'll use the interest on a non-convertible instrument as a benchmark rate. And any difference between the proceeds and the liability is the equity component. The financial liability is a non-current liability in the balance sheet, and the equity will be a part of SOKI, that is other equity, and a tab number 1. So when you consider the accounting of the financial liability in this particular case, you will start doing the unwinding of the discount, and you'll start paying a coupon rate as well. And at the end of third year, depending the holder says cash or shares, I'll do the accounting accordingly. If I'm giving him cash, I'll pay the entire money in cash. Otherwise, the principal is paid in terms of shares. And as far as the equity component is concerned, it shifts to tab number 2. Depending cash or shares, it goes to capital reserve or share premium, as the case may be. That's all. We've done two things today. The parameters to decide the presentation in the balance sheet, 3-step model, 3 charts, 3 perspectives, and the accounting for a compound financial instrument, split accounting. That's all, friends. If you've got any questions, you can ask me. Next class, we will do some very important inputs on this particular standard. So any questions on your side, friends?
Sir, on the third year, then the interest portion, the balancing figure comes to 87,762. 87,762. When you are computing 9% rate of interest, then it is coming to 87,501.
The reason is that when we did the discounting, actually, we did the discounting, and the discounting would have considered figures on a decimal. Now, in this particular case, we've taken 3 decimals. If you take decimals almost like 5 to 6 places, you'll get more accurate results. Then your balancing figure in the third year is going to be more close to that 9% calculation. So because of taking decimals up to 3 places, there could be slight different. If you do this, perhaps, let's say on an Excel sheet with accuracy of workings up to like 7-8 decimals of places, you'll get the exact answer.
Yes, sir.
This is only because of 3 decimal places.
Sir, when when instrument is sir convertible, then why we take interest of non-convertible, sir?
Okay. The reason is that at the end of the day, look at from the issuer point of view. Is he technically liable to pay interest on a non-convertible instrument? Yes. But he, somewhere convinces the other party that you take a lesser interest for option. Which means if I were to calculate my liability, what am I liable to pay? Interest on a non-convertible instrument. But in order to lure him, I made him agree that you take, a lesser interest at 6%. So look at this on a mathematical side as well. If you pay 100 plus 6%, 106, and you discount it back at 6, you get 100. Did you get my point? If you take 100 plus 6%, compound at 6, discount at 6, you reach 100. So which means that in this case, you are not paying him what you should have paid. So which means you told him, I'll give you 106, but you were liable to pay 9. So discounting should be done at the rate which you're technically liable to pay. And therefore, the standard says that the discount rate, the benchmark rate, is always the rate on a non-convertible instrument.
Okay, sir.
Right. Right, friends. I think that seems to be all good for the day then. Time to bid you goodbye, friends. So I'm going to see you in the next class on Sunday. Thank you very much for joining. See you on Sunday morning. Bye-bye and take care.
Thank you, sir.
Thank you.
Thank you very
sir.
much,
Thank you
sir.
so much.
Thank you very much. Bye-bye. Haji, thank you. Thank you. Ji. Same to
Thank you,
ji.
sir.